If you recall, there were two asset classes that were declared dead: office and retail. Okay, they're dead. All right, well, I guess I better give all my tenants money back because it's ours is not dead. I can promise you. But we'll get more into that. But when it goes bad, it's big news. Because for anybody who wants to pay attention, even in the world of tech and everything, this is a real estate-based economy. Always has been, in my opinion, always will be.
Welcome back to the Massive Passive Cash Flow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show. Or if you're watching it, that means you're watching it in recorded mode on YouTube or Facebook. But whatever floats your boat, also on 30 different channels. We have a great guest today, Stewart Heath. And I were just catching up a little bit about telling war stories about our investing days, the good, the bad, the ugly. So first off, I just want to say thank you for being here. I mean, you have a wealth of knowledge and experience, and being an accountant that really, I love working with people who are in technology fields, accounting, business, and attorneys. And it's just we all kind of understand each other. We're perfectly imperfect. How about that? So thanks for being here.
Thank you, Gary. I really appreciate it. It's an honor to be on your show.
Thank you very much. I appreciate that. You're from Alabama, and I've been there a number of times teaching classes all over Huntsville, little town named Madison, just to the west of you, down in Birmingham, Hoover, Tuscaloosa. I mean, all down in what's the coast? Gulf Shores or
Gulf Shores and Orange Beach. Yeah.
Yep. Been there. Yeah. And it's a great state. And by the way, for all the investors out there listening, people in Alabama are probably going to tell me to stop saying this, but right now, Alabama and Arkansas, two of the best states to invest in. Just look at what's happened in Alabama in the last several years. And the cat's not completely out of the bag yet, but just, get down there while you can and meet up with Stewart for example, So Stewart, if you don't mind sharing with us, what got you into this business? Again, was there some pivotal moment, an event, or something your grandfather said to you? Like, what were you doing, and what led you to this?
It's funny you should mention my grandfather. So my dad's a CPA, and when I come along, I said, well, he worked for them, so I guess I'll go to school and do that. I had no idea that I was sort of the opposite of a stereotypical CPA. I don't have any green eye shades, and I don't have a pocket protector. And I actually end up being a lot more like my mother, who was always very entrepreneurial and had a lot of ideas. But her father, my grandfather, passed away when I was 12 years old. And for whatever reason, I got fascinated by all the estate documents. He was a fairly wealthy man. He had accumulated land and timber property most of his life. He ran a sawmill. And so a lot of that land was being divvied up between my mother and her siblings. And at 12 years old, I'm just fascinated by all this. And it's like, wow, they've had this for years and years and years. And now it's worth a lot of money. And the first thing they did was sell off the timber, and then they replanted the timber. And then they sold off the land, to a great big company. So, they cashed in two or three different ways, having leased it for hunting and things like that along the way as well. So they just sort of grew up knowing how to make money off of real estate. That never really left me. So I did go on and attended the best university in the state of Alabama, Auburn, and just so I can stir the pot, for here from the beginning, Gary. We have to have the Auburn-Alabama rivalry. So majored in accounting, got a great job with Pricewaterhouse, one of the big international firms of the day back when there were big eights, and did that for several years. Learned a ton, but I could tell. Stewart wasn't going to be happy until he started doing his own thing. And so the first thing I did was, after about 4 years, left and started my own CPA firm. And still, that wasn't very satisfying. I started a number of different businesses along the way. And what was really kind of formative in an adverse, or not really adverse, but a backwards kind of way was, so I'm coming out of school in 1985. In 1986, there was the Tax Reform Act, which, in my opinion, was the genesis of the recession caused in the a couple of years later, because it immediately devalued all these real estate properties, real estate limited partnerships and things like that, because they had been abusive in the way that they were able to take tax losses, and well beyond any economic reality. But that was the law. There was and so that reversed the value of a lot of properties. And so I'm coming along in a time, and I'd go to these business meetings, and you hear bankers say, "Well, we don't lend on real estate. We like things that are reliable." And I'm like, "Okay, I'm just a young babe in the woods, and I'm taking notes. Okay, no real estate." So a few years later, after I've started my own practice, and I start collecting all these clients, almost all of whom were contractors or realtors or people who were doing a lot of rentals, and I'm just like, "Well, I'm taking the business, but I don't agree with real estate." I mean, because I was told by some very smart bankers that that's dumb, and it took me a few years, and really in the at like 2:00 in the morning in the middle of tax season one day, I'm just sitting here going, "Why are none of these people paying any taxes?"
Yeah,
and they're trading their own homes every 2 or 3 years, getting something bigger and better, and not that greed is the motivator, but they're clearly creating wealth. And so I began to take a new, fresh look at real estate, and again reached back and pulled out that memory from when I was 12, and thinking, well, real estate doesn't really go anywhere. Thinking about my grandfather's estate and all that kind of stuff. And so I really began to get interested in it and studied it for a couple of years before I took a dive into doing it myself. And then I bought my first duplex, and then about 9 months later, I bought 14 more duplexes in one transaction. And frankly, along the way, I had bought Carlton Sheets, no money down course. He was one of the first original infomercial guys I'd ever seen. And I thought, well, it was a money back guarantee. What could I lose? And darned if it wasn't really good, useful information. And there's one of his rules that I still use today. So we'll talk about that later. But and so anyway, I began to accumulate rental real estate. And so by about 2006, I had about 200 personal residential rentals. I'd acquired a property management company, really just to help me manage my own stuff, but we were managing other people's rentals as well. And truth be told, I'm still unsatisfied. I'm still bored. And so I got a contractor's license, and I started building houses, and then started getting into development, and did some stuff in Franklin, Tennessee, where I lived at the time. All of this accumulating until about 2008, 2009, when the merry-go-round stopped. And Warren Buffett famously said, "Well, now we're going to see who was swimming without their trunks on." And turns out I was one of them. Didn't know it, but real estate is inextricably tied to credit as far as the value of real estate. And when the banks stopped, they stopped. And those were interesting times for anybody that remembers. Countrywide Mortgage decided on, I think, in July the 29th of 2008, that we can't fund the mortgages on the 31st that we've committed to. And Bear Stearns had gone bankrupt, and Lehman Brothers had gone belly up, and so forth. And all of these great big giants were going under, and nobody was paying any attention. It's like, well, keep on going. You kind of talked about it in the before we got started. The guys who were selling money were still selling.
Yeah.
Even though they didn't have any product,
Yeah.
so to speak. So, most of us were out there still trying to just do what we do, thinking that there was money there. In 2008 was weird. It was a presidential election year, and John McCain and Barack Obama. And McCain says, let's go off the campaign trail and go back to Washington. They were both senators. And let's go back and solve this problem. And Obama said, see ya.
Yeah.
He kept campaigning, and it was just a mess, is what it was.
Right.
So I basically gave everything I had back to the bank. And most of everything I had done was on my own personal credit, and refinanced this property to go buy that one, and then very little reserves, very little cash, and frankly, it took me all the way under.
Yeah.
And but I never lost my desire for real estate, and I never blamed real estate. A lot of people would say, "Well, real estate's a bad investment." I says, "No, it's not." While Wall Street likes to refer to it as an alternative investment, I like to say, well, no, God created this asset class, and it's the original asset class. If anything, stocks and bonds are alternatives. So anyway, that's kind of how I got into it. I never really lost my love for it. And in 2017, I got the opportunity to get back in it. I didn't want residential rentals again. That wasn't really fun. I wanted to do some commercial properties, and I learned that I needed to build up real equity and have real reserves to be able to go after these properties. And so that's what we've done. So since 2000 to now, we've done 10 syndicated deals, totaling about $50 million. And we've raised $18 million of capital to be able to do that. They're all cash flowing. And now we're in the midst of raising a fund to do more of the same. So that's the short version of my story. So
yeah, well, touch points. So we have in the same year, January 1986. January 20th, in fact, I bought my first house with my college roommate, Socrates, his name. His dad was a Greek immigrant. And we took advantage of the fact that the tax rules were changing for, we call them S-types, self-employed. Dentists, doctors, chiropractors, and we'll consider loopholes. But for young guys like us, back then, I mean, today you can assume VA, FHA, and USDA mortgages. As long as you qualify, like you will qualify for your own mortgage. Back then, though, you didn't have to qualify. We just assumed this guy's first mortgage. He was in the Navy, refinanced his second. His Zach's dad did one thing for us financially. He co-signed that note for us because we had just gotten our first paychecks, from work. We didn't have any credit history. And then the third note was the remaining equity that we gave to the owner. And that was my first experience. But and we again, it just happened to be at the right place at the right time and taught me a lot of good lessons. But the big thing it did, Stewart, is it gave me confidence, because up to that point, my mom, raised us, single mom, she never owned a house. We always rented. And when I told her I was going to buy a house, she was shaking in her boots, afraid, like, what are you doing? Why? That's for rich people. And why don't you wait, save up? And I said, Mom, you don't understand. I've been to Sock's house, his parents' house. We looked at Mr. Demet. So in any case, but now I want to go back to where you are now. So you have a firm, and you don't really like residential. By the way, I don't buy residential anymore. Anyways, it's not that I'm necessarily against it. There's a lot more work. There's a lot more ways to make money in real estate. So I know you've gotten into office, retail, medical. But what can you talk a little bit about that, and what are some of the consistent tax advantage incomes that you can generate across those asset classes? But really, a two-part question. The second part is why is it that most investors, you think, misunderstand the risk in real estate, and in how it shows up in downturns like it did in 2007, 8, and 9, and 10? I know it's a loaded question. First part is, really, what are you doing now? Because it'll help people understand now that they've had their story, how you got there,
Yeah.
why it's important. And then really the risk part of it, that's one thing I've seen most investors. It's not that they don't misunderstand it. I've seen they just don't look at it. They're just
Right.
focused on the upside potential. They're not looking at downside risk. Does that sound familiar? Or?
Want to learn what's working right now in real estate? Then don't miss Monday Night Live, happening every Monday at 7 p.m. Eastern. Each week, we bring you expert training on real estate investing, agent attraction, lead generation, marketing, and AI-powered strategies to help you work smarter and scale faster. You'll also hear inspiring success stories and lessons learned from some of the most successful real estate leaders and investors in the industry. Whether you're a brand new agent, a seasoned investor, or building a high-performing team, there's something valuable for you every single week. Learn, network, grow. Save your seat today and join us this Monday at 7 p.m. Eastern Standard Time for Monday Night Live. We can't wait to see you there.
If you recall, there were two asset classes that were declared dead: office and retail. Oh, okay, they're dead. All right, well, I guess I better give all my tenants money back because it's ours is not dead. I can promise you. But we'll get more into that. But when it goes bad, it's big news. Because for anybody who wants to pay attention, even in the world of tech and everything, this is a real estate based economy. Always has been, in my opinion, always will be. I'll let somebody else take on the metaverse, and they can do all that real estate in the metaverse. And I hope they call it something else because it won't be real. And I'm not against the future. Or anything like that. Just my own experiences guide me to real things, hard assets, if you would. The other part of that is most people that have any sort of means at all, they work with a financial advisor who, let's just face it, are all trained by Wall Street firms from that point of view. And for the most part, those people know nothing about real estate. And that is changing today. There's a great demand among financial advisors by their clients to present them with new alternative investments. I hate that term, but that's what Wall Street has been successful at naming us. And there's more than just real estate in the alts category. So I think those are the two main reasons most people don't create it, because the only time they ever do hear about it, it's bad news, and their financial advisors never recommend it to them. And one of the reasons for that is they don't know how to make money off of it. And I don't really blame them for that. We work with some RIAs now, and we've got several of our deals on a major company's platform. So the RIAs that use that platform, they can put it into the AUM and bill their clients for it. And our cash flow goes through those accounts and stuff like that. So that solves that problem for them. So the first part of your question is, I think, was about how I got to the asset classes we are in now. And I've always had a bit of a contrarian streak in me. So the first deal we did was in 2021, and it was an office deal. I was a fractional CFO at a time for a ministry in Spring Hill, Tennessee, and they owned a building. I'd been there about 5 years, and I walked in the door going, "What are y'all doing with this building?" You kind of had no business, and they'd run a call center in there, and they kept it leased up. And then I just start looking around, and if anybody knows anything at Spring Hill, Tennessee, that's GM's got a plant there. It's where they originally built the Saturn model, and now they do a couple of others. They're building their EV assembly plant and their EV battery plant there. And it's just a very high-end community. So really, as their fractional CFO, I took over management of the building, and all I ended up doing was costing myself more money to buy that building because I got rents up to market. Got things. I just had a passion for it and doing well for the ministry, and since then, since we did buy it, it's just continued to go on. Sometimes you have good things happen that are out of your control. Since that time, Spring Hill has had a sewer moratorium, so nothing new can be built. And
Yeah.
so our real estate just gets more and more valuable every year as the demand goes up. So we'll call that accidental brilliance too. But as I was raising money for that, people were, office. Are you crazy? You know, this building had been full, 100% full before COVID, through COVID, and has stayed full after COVID. I had one turnover in January this year, and it was open for a week. Not kidding. It's like a sign in the ground, and had 14 calls, and then it was rented to a high quality financial advisor, as interested. So, and so I kind of go with what I know. Our next deal was storage. That was kind of a no brainer. You just got a good price. But from there, I sort of discovered medical office, which is actually has become my favorite asset class, as these doctors and these dentists, whatnot, they'll go in and they'll spend hundreds and thousands of dollars on very specialized build outs. And then they don't leave. The last lease renewal I did with one of those guys was a 10-year extension.
Nice.
And last thing in the world they want to do is, go build out all their little operatories with all that plumbing and all that electric. And I mean, it's very expensive build out. And then they spend good money to keep your building looking very nice. And so they are fabulous tenants, and they tend to not be very cost sensitive. And they just need a good location. So they tend to understand their businesses. So that's actually my favorite asset class. But so I would call it suburban office, medical office, and retail. If you remember, all of office was declared dead in 2020, and so was retail. And for starters, office has got at least 6 major subclasses. Nobody ever had any problem at all with their medical office properties. And most of the suburban office, and the designator that I make a difference here is those are places where these tenants meet their customers. The places that struggled are the downtown offices or central business where employers collected their employees, but customers never went to. And they're the ones who had the struggle with getting their employees to come back, after COVID, because they were happy at home in their pajamas and stuff like that. So you got to be careful about any kind of news media reporting. All of anything is never dead. And retail was interesting because, depending on what part of the country you're from, most of us in the South pretended like there was no pandemic from about June of 2020 on. And people were going out to eat. They were going shopping. They weren't going to work, but they were still going out and doing stuff. So it really brings home the truth, the rule that most people have heard of, that all real estate is local. So
well, I tell you what, the truth, that was a great explanation. So looking forward, I understand you've recently written a book, and you also are doing a fundraise for an upcoming investment. Can you tell us a little bit about your book and how people can find it, and then let's get into the opportunity that you have for people, and then we'll wrap it up after that.
Okay. Yeah, I did write a book. It's helpful that my oldest daughter is an editor, so she really kept pushing me, but couldn't have done it without her. But it's a book called "Don't Do What I Did," and my 10 rules for investing in commercial real estate. It's a fairly short book, but mostly each chapter is all about one of the rules. And just for example, the first rule is you make your money on the buy, not necessarily
Mhm.
the sell. And just again, I'm a CPA, and everything really is about the numbers. So if you don't buy it right,
Mhm.
then your chances of maximizing your profits on that are almost impossible. You must run the numbers, and you must buy it right. Obviously,
Yeah.
there'll be a rule in there about location, 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 and I go in and define what that really means. You can't just
Mhm.
say Birmingham is a great market, which it is, but
Yeah.
it's got to be much more narrow than that.
Yeah.
The location is about the neighborhood, or actually the exact street and things like that. And knowing your tenants and the businesses that your tenants are in. So those are just a touch of some of the rules. Anybody wants it, they can have it for free. Just go to our website, harvardgrace.com. Sign up for there'll be a link there. You won't be able to miss it. Just give us your name, address, and email, and we'll send you a free copy.
Okay.
So I
Harvard
hope that
Grace.
harvardgrace.com.
Okay.
Very easy.
Yeah.
Very easy to get that, and I hope that it's helpful to most people, because I really do. Yeah, it's born out of the learnings from earlier in my career, and yeah, the fact that you need reserves, and then how to calculate the reserves that you need, and the proper use of leverage and stuff like that. So,
Well, real estate is absolutely learned by doing business, and the best way to.
absolutely,
And
yeah,
so, if you learn from other people's experiences, I mean that's key and vital, and I really appreciate you
yeah,
offering that. You know?
absolutely, yeah.
Yeah. Mm.
So to date, Harvard Grace Capital has done 10 different deals.
Mhm.
We call those single asset syndications, where we've raised money and acquired, and we operate those 10 properties to date. What we're working on currently, and all of those have been in the category of stabilized commercial real estate in one of the classes that I've already mentioned: medical office, storage, retail, stuff like that. And so this time we're taking a bit of a different approach. We're raising a fund. We're going to raise $20 million, which will mean we'll do about $60 million of real estate transactions. And it's going to be more of the same thing that we've been doing. I don't know that I mentioned before, we are the property managers for all of our own assets, which is why we sort of keep it to a tight geography from Nashville to Birmingham, so that we can get to them quickly if we need to. So we're kind of doubling and tripling down, if you would, on what we've had success at doing. This is a tremendous target-rich environment, sort of hubbed by Huntsville, Alabama. You said you've mentioned, I mean, Alabama is a great market, and Huntsville's probably the leader of that, but all the way down at the other end, Mobile's having some great strides forward. And both of them are led by government investment. Mobile, interesting economy, but the government is expanding their port down there, and it's already been successful with shipbuilding and stuff like that. Which is, and not to mention the other end, they've got tremendous tourism with the beach communities of Gulf Shores and Orange Beach. So the whole state, to me, it's low tax, it's business friendly, and we also invest in Tennessee. Today, we've invested in Tennessee, Mississippi, Alabama, and Florida, and these are all great economies that have tremendous opportunities. So.
Yeah. Well, it's funny how many places you mentioned I've been to, including Spring Hill, Tennessee. I taught a class there as well. So I love it down there. It's always been a lot of fun. We used to call that. By the way, my first job, I had a computer science degree, was with NASA at Langley Air Force Base, and we interfaced with some of the folks in Huntsville. We call it the Pentagon of the South. The rocket technology was developed, tested there. And of course, we already know about Houston and Cape Canaveral, but what a great experience for a young man. And And by the way, everybody listening, if you think about, the type of mind that Stewart has, an accounting mind. I don't have an accounting mind. I have a computer mind, but my best partner in all business, and he's actually working with me today on my current business, which is a national team of agents that work with investors, is an accountant. We're a perfect match, we're alike enough to get along and be really good friends, and unlike enough to be very complimentary and balance each other out. Where I have no skills, he's got it, and vice versa. So if you guys are interested in participating in an up and coming project, reach out to Stewart. Go to the website, harvardgrace.com. Leave your information. There's probably going to be a vetting process. We're not attorneys, and well, Stewart might be a tax professional. I'm certainly not. But in any case, actually,
Once upon a time I was. I don't consider myself to be one anymore.
yeah. But what you're doing now is extremely valuable. When you help people get from where they are to where they want to be, financial terms, and help them create financial peace in their lives, you got friends for life. But I've developed more friendships from being in business than I ever got business from friends. It's just kind of interesting because,
Well said.
if people that, if you look at some of the things I've done, it paints a certain picture, but I really am just a regular guy. I just have have done certain things an awful lot over a long period of time. And like anybody, just like you and your experience, you took what the hand of cards you were dealt and, played your hand and did the best you could. And look at you now. You turned a lemon into lemonade, and now you're helping a lot of people. There's no better vocation than serving others. So for all the listeners, I hope you enjoyed this. If you could please leave a review. Stuart and I certainly appreciate that. Your reviews help our world go around. That's how we get paid. Your review doesn't cost you anything, but for us, it means we get more exposure, and we're a public service in what we do. We serve others. But in any case, Stuart, thanks again for joining us. And thank you, listeners, for listening. God bless all of you and your families, and we will see you on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.